For the rest of Chapter 4, we'll be focusing on job costing systems. So job costing systems accumulate cost according to specific jobs, customers, projects, clients, or contracts. We mainly record this on a document called a job cost sheet. This keeps track of all of the information for one particular job. A job cost sheet is started when we start that service or job. So this is an example of a job cost sheet. We can see what we have: the product, the name of the date, or the date begun, the date that we're supposed to complete it, what the unit cost amount is, what we've requisitioned for direct materials, our direct labor, and our factory overhead. So in this order, we're making 20 end tables for a customer. We also have our job number up in the right-hand corner. We collect all of this information on the job costing system. As we go through the production process or the service, whatever job we're completing at that time, we keep adding costs for that job. Once we've completed the job, we allocate to that job. All costs appear on the job sheet are recorded in the work in process inventory account as we move them from direct materials and direct labor into our work in process inventory. The total of all of our active job sheets should equal the amount that we have in our work in process inventory account. We have direct materials and indirect materials. When we receive direct materials, we record them in materials inventory. We'll have a bill of materials. This is a list of the materials needed for each particular project or product. We will make a request with a materials requisition. We will request the supplies out of our inventory that we need for a job. We then assign them to production and transfer those costs of materials into our work in process inventory and record the direct material costs on our job cost sheet. Our indirect materials are moved over and recorded in factory overhead instead of work in process inventory. As we allocate overhead to our jobs, then we record that on the job sheet. This is an example of a bill of materials. So we have our item is that end table that we are producing, and then we have all of the things that we need to make an end table and how many of them that we need. When we requisition materials from our inventory, these are the items that we need to produce that end table. So our order is to make 20 end tables, if you remember from our original job cost sheet. We're going to requisition the items that we need to make that. So we need a drawer pull for each end table. So we're going to fill out a requisition asking for 20 drawer pulls. We're assigning them to our job 351, which is the order for 20 end tables. Our direct labor is recorded from our timesheets in our time tracking system. However, we have employees log in and record their time, whether that's a physical timesheet or a computerized timesheet. So we get the information about which employee worked on each job, what their pay rate is, and then our total labor cost for that job. Our indirect labor is recorded to factory overhead. At the end of jobs, we allocate overhead costs to individual jobs. We have actual, normal, and standard costing. Under our actual application method, overhead costs are tracked for each job. Under the normal application method, overhead costs are applied to various jobs using a predetermined factory overhead rate. So if you'll remember that predetermined factory overhead rate is the most common way to apply overhead. We can have a single rate for predetermined factory overhead rate, or we can have multiple rates depending on which cost system we use for applying overhead. Our predetermined rate is an estimated rate when we budget out what our overhead costs are going to be for the year. And then we have our estimated allocation base. So then we estimate how many direct labor hours we're going to use in the year, how many machine hours we're going to use in the year. We assign overhead to jobs based on this predetermined rate that we calculate. We have a four-step process for determining what that predetermined overrate is. The first thing that we have to do is estimate what our total factory overhead is going to be for that operating period. We generally do this for a year. Then we select the appropriate cost driver that we're going to use to apply our factory overhead costs, whether it is direct labor hours, direct labor costs, machine hours. Then we estimate the total amount or activity level of that chosen cost driver for the operating period. So this might be if we've decided that the appropriate cost driver is direct labor hours, then we're going to estimate how many direct labor hours we need for the year. We divide that estimated total factory overhead cost by the estimated amount of our chosen cost driver, and that gives us our predetermined overhead rate. We can have a plant-wide rate, which is a single rate, or departmental rates. Departmental rates give us multiple rates. So when departments differ significantly in the amount of overhead costs, departmental rates are more appropriate. If our production is pretty similar among all lines, a single plant-wide rate is appropriate. It really depends on our company, what our company does, and how our company is structured, whether we would use a plant-wide rate or a departmental rate. Then the other way we can source out is also by activity rates, which will happen in another chapter. So we have our predetermined overhead rate, which is our estimated factory overhead for the year divided by our estimated level of cost driver for the year. We have an example of various cost drivers: direct labor hours, machine hours, number of machine setups, number of orders, manufacturing cycle time. What the cycle time is how many days it takes to manufacture an item. We take our overhead rate that we calculate and we take that times the actual activity. So our overhead rate is based on estimates that we determined at the beginning of the year. The actual activity is the actual amount of allocation base that we've used, such as direct labor hours or machine hours or number of setups or number of orders. When we apply that factory overhead, it's rarely equal to the actual overhead costs incurred during that period. At the end of each period, then we will have over-applied overhead or under-applied overhead. This difference should be a small amount if our predetermined factory overhead rate is fairly accurate. The factory overhead account is a temporary account that needs to be closed at the end of each period. When we close that temporary account, we have two possible ways to apply that treatment. The one is to close it to cost of goods sold. This means that the difference, whether under-applied or over-applied, the full amount of difference in the overhead account gets applied to the cost of goods sold account. The second treatment is that we adjust the production cost of the period by prorating the difference in the overhead account from to across work in process, finished goods, and the cost of goods sold account. It says that proration is explained in chapter 15. That's when we'll see examples of it. But generally, when we decide whether or not to just close the full amount or to prorate the amount, depends on the total amount that we're talking about. If it's a very material amount or a large amount, we're going to want to use the proration method. We might also want to think about revising our estimated overhead amount if we have significant numbers in that account. We have potential errors in overhead application. One example of the error is if we have a plant-wide rate rather than a departmental rate. So this error can occur because we have different usages across our departments of overhead. So a plant-wide rate is not the best rate to use in that option. The specification error occurs when the wrong cost driver is used, where machine hour would have been a better driver than labor hours or vice versa. And our measurement error arises when we have estimation and calculation errors. So we've made a mistake in our math somewhere, or we made a bad estimate. Job costing is used in service industries extensively. We have advertising agencies, construction companies, hospitals, accounting firms, law firms are just a few of the ways that we can use job costing systems. Our cost object or our job is usually an individual client, a contract, a project. The main difference between manufacturing and service industries is that we don't have direct materials necessarily in service industries. Our main focus of a service industry's costing system is our direct labor. Our overhead rate then for a service industry is usually based somehow on our usage of direct labor, either our total direct labor cost or in direct labor hours. For example, in accounting firms and law firms, it's very common to track your time in 15-minute increments. And when you switch between clients, you keep track of which client you are working on and each 15-minute increment you are working on for that client. Operation costing is a hybrid system that uses job costing to assign direct material costs, but processing costing to assign our conversion costs. Remember, conversion costs are those costs we use to convert direct materials to finished goods. We use that a lot in manufacturing companies when our conversion activities are similar across several product lines, but those direct materials vary significantly. So think about like a food production. We can think about soup. The direct materials across different kinds of soup vary. Some soups might have carrots and some soups might not. But the canning and labeling of those soup cans is the same across every product line. The only thing that changes is the outside label, but the process is the same. So a hybrid system would be commonly used in that instance. We also have spoilage, rework, and scrap. So spoilage is when we discard or sell items for less money. Our normal spoilage occurs under normal conditions. So this is just spoilage that occurs in a normal work environment. Maybe we have in our example of end tables from the chapter, we might occasionally get pieces of wood that have knots in them or have other flaws that we don't want to use when we're making furniture. So we would just throw those pieces of wood out. That would be part of our normal spoilage or scrap for that. If we have abnormal spoilage, this is less than our normal occurrence. This can occur from a variety of reasons. Natural disaster is one of them, or the loss of power if we're in a food industry or a retailer that has food and our power goes out, then our food is all going to spoil because we don't have refrigeration from loss of power. We're seeing that right now with all of the hurricane damage that's happening across the United States. Places are losing power for long periods of time, and we're having losses from abnormal spoilage. When we have rework, this is when we had some kind of a flaw in the unit that can be fixed. We can go back and we can rework it into units that can be sold as good finished units. We might have a normal amount of rework that happens in our department. We just have to adjust a couple of things. If we have abnormal rework, then we're going to charge that to a abnormal rework account. Scrap is material left over from the manufacture of product that has little or no value. In a further chapter, we're going to talk about scrap that happens from products that we can use for value. For example, if we have wood chips that are left over after we process wood, we can sell those wood chips. They don't have the same value as the wood. Those are then called byproducts. It's a type of scrap that does have a nominal value that we can sell. But scrap is common to all jobs, and it ends up in our factory overhead account. We can have abnormal scrap, but that's usually as part of our spoilage or rework process, where the reason that we had to scrap a lot more than normal is because we were ruining it as part of the manufacturing production process. There are ways to reduce the amount of spoilage, rework, and scrap we have, which usually involve employee training. That is the end of chapter 4.